Okay, so now that you know you're supposed to sell a vertical if the volatility rank is over 50, how do I sell a vertical? What do I do next? Well, that leads us into trading rule number 4. I'm so glad you asked. Which says, when we sell a vertical, we are looking for a minimum of 33 cents to a maximum of 40 cents per dollar width of strikes. And that's going to make absolutely probably no sense to you right now. So just learn this rule for what it is. Trading rule number 4 is we sell a vertical for a minimum of 33 cents to 40 cents per dollar width of strikes. So let's illustrate this point so it actually makes a little more sense. So here's a trade page for selling a call vertical, and we're going to go through this very slowly and in depth because this is super important, because it's obviously the groundwork for everything we do moving forward. So let's start up here. We see in this case the volatility rank is 92. Immediately that means, based on the rules, I want to sell a vertical. Trading rule number 4 requires that I sell a vertical for a minimum of 33 cents to 40 cents per dollar in width. What does that mean? Well, let's start out by setting up this vertical. So we're going to sell a call vertical here, and we're going to start by selling the 43 call, which means we want the stock price to go down, and we're going to buy the 44 call to define our risk and turn this into a vertical. So what's our width of strikes? Well, I think you can see here it's 44 minus 43, which means a dollar width in strikes. And what's our rule? We want to get anywhere from 33 to 40 cents per dollar in width. Okay, what does that actually mean? Well, if you see over here, you see when I sell this, I'm selling it for 33 cents, which of course we know is $33. We all learned the rules about times 100. But that meets our rules. 33 cents, 33 cents. That's the minimum amount of money we're willing to sell a $1 wide call vertical for. And if you look over here, of course, you know the most you can make when you sell any kind of option is what you sell it for. So if we sell it for 33 bucks, it's the most we can make, which means the most we can lose is $67. And why is that? Because as you see down here, we know width of strikes, everything in options is times 100. So a dollar width in strikes equals $100. Our credit is 33 cents, which means it's times 100, which means it's $33. These two numbers always have to equal the dollar width in strike or the 100 bucks, and they do. 67 plus 33 is 100. The dollar width in strikes are 33 cents minimum sale price. So this is a good trade. It's between our 33 to 40 cents per dollar width, and that's what it means. That's what the dollar width and the 33 to 40 cents means. And if we go down here, we see it also meets our rule of being as close to 45 days as possible. In this case, it's 37 days. And what's even better about this, look at this POP, right? We're not used to seeing these high POPs for, just regular defined risk kind of trades. But in this case, we are selling a call vertical, so we're completely protected. We know exactly how much we can lose. We know exactly how much we can win. There's no undefined risk here. And yet our POP is still 65%. That's awesome, okay? And that's the beauty of verticals. So it meets all our rules. It's between 33 and 40 cents per dollar width. It's close to 45 days. Our POP is 65%. This is a great trade, and that is how you sell a vertical. In this case, it's calls, but that is how you sell a vertical. And just because I think it's important to visualize what we're doing here, we just sold the 43-44 call spread. So what does that actually mean, when we're kind of looking at the world and stocks in general? Well, here's the stock we're looking at. We're looking at Yahoo, and this is the graph. All the greens mean is that the stock price closed up that day. The red just means the stock price closed down that way. So it's not important for us right now. This is just kind of the price range it's been over the last few months. And if you look over here in the orange, this is where the stock is right now. The stock is at 41.14. Now remember, we sold the 43 call spread. So what that means is all we want to happen is the stock stays below this green line and we're a winner. So now I think you can see why our POPs are relatively high. It's because the stock price is way down here. We just need to stay below this green line and we're a winner. And that's why our POPs are so much higher when we sell verticals in this way, the 33 to 40 cents, etc. We're going to get these much higher POPs. But this is what it looks like on a graph. This is what we're actually looking to do. We're looking to stay below this line. We're already below this line. That's a good thing. That's why our POPs are high.